People always ask me, Charlie, what should I do with my money? And the first thing I ask them back is, where is it now? And you know what they say in the bank. In the bank, just sitting there, earning what? Half a percent if they re-lucky, while inflation runs at 3, 4, 5% or more. They losing money every single day and they don't even realize it. Being rational is a moral imperative. You should never be stupider than you need to be. And keeping all your money in a bank account, especially in times like these with inflation eating away at purchasing power. That is being stupid. Let me tell you something about banks. Banks always tell you to put your money in the bank and make more money. Do you think the banks are saying this for your benefit, or are they saying it for their own benefit? I'll give you a hint. It is not for your benefit. When you put money in the bank, you are lending it to them. They pay you maybe 1%. Then they turn around and lend it out at 5, 6, 7%. Or they invest it and earn even more. You are doing all the saving, taking all the inflation risk, and they remaking all the money. I've been investing for over 70 years now. And in all that time, I've never thought of cash sitting in a bank as an investment. Cash is a tool. You keep enough for emergencies, enough for opportunities. But beyond that, it needs to be working. Let me walk you through 5 types of assets that have served me well over nearly a century. Assets that actually build wealth instead of slowly losing it to inflation. The first one, and this is the foundation of everything Warren and I have done, is stocks. But not just any stocks. Quality stocks, stocks in wonderful businesses. Robert Kiyosaki talks about stocks being one of his favorite assets. He is right about that. By purchasing shares of successful and world-renowned companies, you can own a part of these companies through their stocks. While cash offers us limited earning potential, stocks have the potential to yield higher returns. But here is where I differ from a lot of people. I am not interested in trading stocks. I am not interested in hot tips or what is going up this week. I am interested in owning pieces of exceptional businesses for very long periods of time. A great business at a fair price is superior to a fair business at a great price. I've said that for decades, and it is absolutely true. You want businesses with durable competitive advantages, businesses that can raise prices, businesses that generate cash. When we bought CS Candy, we didn't know the power of a good brand. Over time, we just discovered that we could raise prices 10% a year, and no one cared. Learning that changed Berkshire. It was really important. That is what you want in a stock. A business so good that it can weather inflation, recession, competition, whatever comes. And if you hold it long enough, the compounding does incredible things. Let me give you an example. Let's say you invested $10,000 in Coca-Cola stock in 1988. Warren did. By the way, big position. That $10,000 would be worth well over $500,000 today, plus all the dividends you collected along the way. That is the power of owning quality businesses. Not speculation, not trading, just patient ownership of wonderful companies. It is waiting that helps you as an investor, and a lot of people just can't stand to wait. You have to be very patient. You have to wait until something comes along, which, at the price you are paying, is easy. But when you find those businesses and you hold them, that is when the real wealth gets built. The second asset, and this is something I've thought about carefully over the years, is precious metals, gold, silver, platinum. Now, let me be clear about something. I am not a gold bug. I don't think gold is going to make you rich, but I do understand its role. Gold has never been a worthless asset throughout history. It makes sense to raise capital and allocate a portion of it to gold as a store of value. In most countries, regardless of how shaky the economy is, precious metals can somehow survive and appreciate in value. I remember the 1970s terrible inflation. The dollar was losing purchasing power rapidly. And gold. Gold went from $35 an ounce to over $800. People who had some gold in their portfolio preserved their wealth. Now, would I put a huge percentage of my net worth in gold? Number, absolutely not. Gold doesn't produce anything. It doesn't generate cash flow. It just sits there. You are betting that someone will pay more for it later than you paid for it now. But as a small allocation, maybe 5–10% of your portfolio, as insurance against currency debasement and extreme inflation, that makes sense to me. Especially now when we see governments around the world printing money like there is no tomorrow. When you see that happening, having some gold as a hedge, that is not crazy. That is prudent. The third asset is index funds. Now, this might surprise some people who know my history. Warren and I, we built our fortunes by picking individual stocks, by finding wonderful businesses and concentrating our capital in them. This worshiping at the altar of diversification, I think that is really crazy. IV said that. And I mean it. If you know what you are doing, concentration makes more sense than diversification. But here's the thing. Most people don't know what they're redoing. They don't have the time. They don't have the interest. They don't have the skill to analyze businesses properly. For those people, index funds are perfect. When you invest in an index fund, you have shared your investment risk across multiple companies and industries and achieved a diversified portfolio. You are basically buying a piece of the entire economy. The S&P 500, for example, it is 500 of the best companies in America, technology, healthcare, consumer goods, financials, energy, everything. And historically, it has returned about 10% a year over long periods. Is that going to make you as rich as picking the next Amazon or Apple early number? But it will absolutely beat leaving your money in the bank. And for most people, it will beat their attempts at stock picking. Big investors like Robert Kiyosaki, who generally aim for long-term and stable growth, prefer index funds and think of it as a kind of passive income. And he is not wrong. The key is low costs. You want an index fund with minimal fees. Every percentage point in fees is a percentage point that doesn't compound for you. Over 30–40 years, that makes an enormous difference. If you are putting money away for retirement and you are not a professional investor, put it in a low-cost S&P 500 index fund and forget about it. Don't check it every day. Don't panic when it drops. Just keep adding to it regularly and let time do the work. The fourth asset is real estate. Now, the video talks about crowdfunding investments, investing in startups and projects through platforms. That is fine. But let me tell you about real estate more broadly. Real estate, if done properly, can be an excellent inflation hedge. Property values tend to rise with inflation. Rents tend to rise with inflation. If you buy well and manage properly, real estate can generate consistent cash flow. I've seen people build substantial wealth through real estate over the years. Not by flipping, not by speculation, but by buying solid properties in good locations, renting them out, and holding them for decades. The key is not to over-leverage. As you can tell in Berkshire operations, we are much more conservative. We borrow less on more favorable terms. We happier with less leverage. You could argue that we've been wrong and that it has cost us a fortune. But that doesn't bother us. Apply that to real estate. Don't borrow 95% to buy a property. Don't assume rents will always go up and vacancies will never happen. Be conservative. Have reserves. Buy quality properties in quality locations. Real estate also has tax advantages in most countries. Depreciation, mortgage interest deductions, the ability to defer capital gains through exchanges. Used intelligently, these can significantly enhance returns. But again, don't get greedy, don't over-leverage, don't speculate. Buy for cash flow and long-term appreciation. The fifth asset mentioned is foreign currencies. If you believe that keeping your money in cash will not benefit you much, you can consider converting it into another foreign currency. Diversifying assets across different currencies can create opportunities to take advantage of price fluctuations. Now, let me be honest with you. This is the one I am most skeptical about. Currency speculation is difficult, really difficult. You are betting that one government will be less irresponsible with monetary policy than another. That is a tough game. That said, having some international diversification makes sense, not as speculation, but as protection. If all your assets are denominated in one currency and that currency collapses, you are in trouble. So maybe you own some international stocks, maybe you own some property in another country, maybe you keep some cash in Swiss francs or Singapore dollars, not as a bet against your home currency, but as insurance. The key is not to overthink it. Most people should not be actively trading currencies. Investing in foreign currencies will require extensive and professional research. And even then, it is extremely difficult to do consistently well. Better to focus on buying quality businesses, regardless of what currency they trade in. If you own great companies in multiple countries, you automatically have currency diversification. And you also have the underlying business value, which is much more important than currency fluctuations. Now, let me bring all of this together. The video is right about one thing. Banks tell you to keep your money with them for their benefit, not yours. In today's world, inflation is very high and the value of traditional currencies is declining. So what do? You take that cash and you convert it into productive assets. Quality stocks in wonderful businesses, maybe some precious metals as insurance, index funds if you are not a professional investor, real estate if you understand it, perhaps some international diversification. The key is understanding that cash is not an investment. It is a tool. You need some for emergencies, you need some for opportunities. The way to get rich is to keep 10 million in your checking account in case a good deal comes along. Well, most people don't have 10 million, but the principle is the same. Keep some liquidity, but put the rest to work. I constantly see people rise in life who are not the smartest, sometimes not even the most diligent, but they are learning machines. They go to bed every night a little wiser than they were when they got up. And boy, does that help, particularly when you have a long run ahead of you. The same applies to building wealth. You don't need to be brilliant. You don't need to get rich quick. You just need to consistently convert your income into productive assets and let them compound over time. As I look ahead to 2025, 2026, and beyond, I can tell you this with certainty. Inflation isn't going away. Governments around the world have too much debt. They're going to keep printing money, which means currencies will continue to lose purchasing power. In that environment, keeping all your money in the bank is financial suicide. Slow suicide nonetheless. Every year, your purchasing power declines. Every year, you get a little bit poorer in real terms. The solution is simple. Own productive assets. Own real estate. Own things that generate cash flow and appreciate with inflation. It is remarkable how much long-term advantage people like us have gotten by trying to be consistently not stupid, instead of trying to be very intelligent. Don't be stupid with your money. Don't leave it in the bank, earning nothing while inflation eats away at it. Convert it into assets that work for you. That is how I've built wealth over 99 years. Not through brilliance, not through luck, but through the simple, boring practice of converting income into productive assets and letting them compound. You can do the same. Start today. Take some of that money sitting in your bank account and put it to work. Buy quality stocks, buy an index fund, buy some gold, buy real estate, whatever makes sense for your situation. Just don't leave it in the bank doing nothing. That is not prudence. That is not safety. That is slow financial death. And you deserve better than that.